Yeah, we always flag for ResMed. The quarters are quite volatile and expected coming into this quarterly result. But what I see now is just utterly ridiculous. I mean, this stock got smashed here on Friday, closed down 9%. It's a 6-month low, and then the States did one better. Leave it to the Yanks. That's right, 18.5% down. It's a 3-year low coming out of Friday's trading point. Really setting it up today to be whacked once again. Now, what sins did ResMed commit for that sell-off? Well, really, it's very interesting. The sales have been catapulted, for lack of a better word. Third consecutive double-digit gain, up 23%. Now, I haven't seen that result in a decade for this company. Really good, strong top-line growth. That's really unconstrained supply. We still have its main competitor, Philips, is out of the market. That's really supporting underlying device growth. This is a major product line for them. 50% of their sales are devices. And masks is the other 50%, really benefiting from new patient setups and resupply of those masks are getting on patients. That's really good to see. But that strong top line really failed to translate into equally strength in the underlying profitability. It was up 13%. The culprit here is really the gross margin line. It was down 200 bips. That's really on unfavorable product mix and really higher inventory component costs flying through that model. Really suggesting to the market that it's going to take longer for those margin recovery coming out of COVID to go back to more normality. Now, this is despite, here's the sin, despite management last quarter coming out pretty confident that the margins are on the nadir last quarter and on their way up. So investors really fear that the margin compression is more permanent than not, and management's misstep actually combined for a pretty toxic mix. But if you really look past that print, you can really see this was really self-induced, and it's not really a structural impulse. If you really looked at it, not really what the numbers actually lead you to believe. So quite simply, the demand was so strong in this last quarter that ResMed sold way too many, get this, way too many of their products. I think it's a good problem to have. But unfortunately, those products carry lower margins, therefore pressuring their overall company margin at the expense of underlying profitability. So why this product mix is unfavorable and the company is working through higher priced inventories. It's purchased those inventories 9 to 12 months ago. And we all remember the COVID supply disruptions. They're still working through their way through the model. And yes, management did fail to manage expectations. We saw this with CSL. We've seen this with ResMed. I just know what the hell's in the water. But when you have these large caps just failing to manage expectations, you think something is up. They're much better normally at doing that. So that's quite disappointing. But even on the call, management admitted that they went out on a limb, quote unquote, last quarter, targeting improving leverage. And it didn't do a good job of explaining it. Yeah, go figure. But what they really wanted to point out, what I really wanted to say is they're very, very focused on this brand, on improving patient needs and getting people on therapy, right? So they're ensuring, they said, that nobody is, quote unquote, left behind. So with demand so strong, they really opted not to slow down sales and to reverse engineer the gross margin, which all these companies can very easily do. But they decided to give the patients what they need and not to appease the market. Well, they got slammed for it, but it's in the patient's best interest, to tell you the truth. So it appears that expectations were poorly managed, obviously, but a bit of altruism here was at play, where the demand fulfillment, as I said, was really what was given despite you have the unfavorable product mix and the higher inventory levels. So that trumped short-term profitable growth. It's essentially what it is in a nutshell. But I look at it as saying, well, isn't an expanded install base and franchising your customer really the key to long-term sustainable growth? Yeah, it is. So it's actually a net positive. Now, obviously, it's taking a little bit longer for those margins to come back. The company has to move their lever, to pull that. But we're looking in 2024, a margin more likely to improve than not. We have moderating headwinds. Improving geographic mix. I just talked about the mix is wrong, needs to improve. We have stabilizing component costs. I said they're pushing the inventory costs through the model, and as that slowly goes forward, those costs are mitigating or going down. They're actually stabilized now. Manufacturing efficiencies are yet to flow through as well, and you have lower logistics costs. So those are moving in the right direction. And you definitely have emerging tailwinds. We have the declining inventories I just pointed out. We have their new launch called the S11. That's a higher a margin product. That's on allocation still. So once that gets through the model, you're going to get more uplift as it sells more of those products. It's running 2 platforms, by the way, this S11 and S10, which is an older platform. The S10 is not on allocation, but that's supplying the market. And they're running 2 platforms. Normally only run 1. They're running 2 to supply the market. But see, it's at the detriment of their margins near term. But we've got to really remember that this company is also spitting out a truckload of cash. I looked at the operating cash flow this quarter. It nearly doubled sequentially, and it's yielding 25% on an operating cash flow basis. You'll find all that nitty gritty. I published a note overnight. Happy to take questions offline, or you want to run through other questions. The key point of that note, you look at my earnings changes, they're below 1%. They're negligible. I shaved a little bit off the price target, still see 20+% upside for this company, forecasting 13% CAGR through 2026, still looking really quite strong and quite good. Now the stock's trading 1 standard deviation cheap. Yes, it's bloody oversold. But what happens today? I would wait for the dust to settle, and hopefully there's some sanity that gets reinjected back into the market. Well, let's see. Hopefully the ASX can trump the NASDAQ. And there's, like I said, the stock comes to find a level that's not going to sell off over 10%.